So we'll begin with corporate issuers. So this is a very easy subject only. Most of the things you will fitted and theoretical as well. And even some few sums are there, but those are also very easy one only. Because now you have finished most of the subject, you will have a lot of overlapping stuff also. Organizational forms and corporate. Uh, okay, yeah. So organizational forms, corporate issuers, features, and ownership. So here, these are different types of businesses. Sole proprietorship, they have unlimited liability. Then general partnership will also have unlimited liability. Partners in this one, limited partners will have limited liability. Okay, so partners also will have unlimited liability. But when it is structured as a limited partnership, then only general partner will have unlimited liability. Rest all will have limited liability. You know this one. You know what is unlimited liability? Unlimited liability means you have to sell your personal property as well to pay off the loan. Okay, in case you have taken loan for your business and you are not able to pay off, you will be forced to sell from your personal property as well. Reason being, unlimited liability means here you are similar to your business. That means you are no different. So if your business is borrowing, it is as good as you are borrowing. So your liability is unlimited till you pay. I mean, you have to sell your personal property also to pay off all the liabilities. But if it is structured as a limited one, limited means what? Limited here represents for limited liability. So limited here represents limited liability. So limited liability as in okay, limited liability as in what? So limited liability is uh, when you are borrowing, that means company is borrowing, you are not borrowing. So because company is borrowing, you are different from company. Okay, so legally these two people are different. Company is different and you are a different person. So if company is borrowing and company is not able to pay off, they cannot touch your personal property. So imagine tomorrow, like let's say uh, any company you take, like Reliance company is going bankrupt. Now nobody can touch Mukesh Ambani's personal assets for this, because who borrowed? Reliance borrowed, not Mukesh Ambani. Is it okay? Are you able to understand these terms?
Yes.
Okay, so in a limited liability partnership, general partner is not required. Everybody will have limited partners. So we have such kind of structures now. All are limited partners. Then the owners, that means shareholders, appoint board of directors who is responsible for hiring senior managers to operate the company. So this is like, we are appointing MPs, member of parliament. They will run the parliament. Okay, that way. And then they will appoint one PM also. That PM is what? That PM is a CEO. Okay.
Okay.
Then these all are common points. Double taxation. Depending upon the country, a corporation's profits may be subject to double taxation if the government taxes companies on their earnings and it taxes dividends as their personal income. Okay, subject to double taxation if the government taxes companies on their earnings and it taxes dividends as personal income. You're able to understand that means company, let's say company made 100 rupees profit. If company is making 100 rupees profit, okay, company made 100 rupees earning before tax. And if earning before tax is 100, so tax is let's say 30 percentage, now 70. Now assume all these 70 rupees is paid to you as a dividend. You are the only shareholder. So now you are, you know, you are also falling into the tax bracket of 30%, let's say. So in that case, again, you have to pay 30%. So 30% comes to 21 rupees gone. So it will be 49, correct? So from 100 that the company earned, finally you are getting 49 only. Mm, okay.
Yes.
Okay. Then articles of incorporation means what, articles of incorporation, memorandum of association. See, memorandum of association and articles of association. Memorandum of association. So memorandum of association means this will tell you company's relationship with outsiders. Company's relationship with outsiders. That means company's relationship with outsiders means what sort of company, what do they deal with, what is their vision, then where is their office headquartered, what sort of business are they doing. Okay, so all those details will be mentioned here. Similarly, articles of association. Articles of association means company's relationship with its own, let's say, insiders, with the employees. With the employees. Here, it will be rules and regulations about how it has to be done. Say, for example, what will be the salary of the board of directors? How often board of directors are going to come and meet? Okay, so internally, how the company is going to run, that rules will be mentioned here in articles of association. So basically, these are all the structural documents of the company. Okay, this is articles of incorporation. That means when the company was incorporated, it's like articles of incorporation. You can even call that as the birth certificate. Okay, birth certificate. So it will have details about when that company was incorporated. Okay, and at which address it was incorporated, what is the complete name of the company, such details. So you can think like this is the birth certificate of the company. Okay. Then voting rights is all okay. So double taxation is, this is what I was telling you. See, 10 million earning before tax. Then corporate tax is 25% and shareholders tax are 20%. So 25% deducted. Then after tax net income is 7.5 million. Assuming all are paid as dividend. Now you are getting this 7.5, but you have to pay 20% tax on that. So 20% of 7.5 comes to 1.5. So your total tax that you have paid is 2.5 as well as 1.5, just like over here. 3 rupees you have, 30 you have paid. Here again 21 you have paid. So overall you have got only 49. That means overall tax is what? Total tax will be 51%, right? Because you earned 100. 51 rupees is gone as tax. So same way only here. Okay, here this is, see, finally after earning 10 million you are getting only 4 million. No, not 4 million. Total tax that you are paying is 4 million. 2.5 and 1.5, 4 million. So your tax is 40%. Similarly, here partially dividends are paid. So 3 million. Okay, so taxes on dividends in this one, 20% of 3 million comes to 600,000. So 2.5 and 600 comes to 3.1 million, which comes to 31% of 10 million. Okay, you're able to understand this sum. This is just this one only, nothing else. Okay.
Yes, I understand.
Yeah. Then free float, okay, is typically expressed as percentage of total shares outstanding. That means, what do you mean by free float? Imagine the company has 100 shares. Now in that 100 shares, let's say promoter is owning 60 percentage. If promoter is owning 60 percentage, then free float is considered as remaining 40. Okay, promoter and families are owning 60 percentage. So free float means which are available in the market for buying and selling. That is only 40 percentage. Okay.
Okay.
Then private placement means raising capital privately. Privately means from institutions without going to the public. Or publicly you are not raising capital. Privately you are approaching institutions and you are raising capital. That is called private placements. Then accredited investors. Okay. Corporate investors or high net worth individuals. Uh, then IPO, I'm sure you know. Then SPAC means what? SPAC means this concept is not there in India. SPAC means it is a structure wherein they raise capital IPO only to buy another company. That is the business model here. Okay. So they are buying another company. I mean, they want money to buy another company. So they are raising money from the public. That is called SPAC business model. So this is there in US and all, but we don't have it. Okay. Is a corporate structure set up to acquire a private company in the future. So SPAC raises capital through IPO and puts the fund into a trust that it must use to make an acquisition within a specified time. So it's like a blank check company is getting. So which company they will buy, that we may not know. Okay, so later on you just read all this theory properly and then attempt this question.
Okay.
Then reading 21, investors and other shareholders. Impact of leverage on return on equity. So impact of leverage. This I have done in leveraged return. You remember in alternative investments I did leveraged return.
Yes.
Le-
That formula.
Hello.
Hello. Hello.
Okay, wait. I'll just reconnect it. Yeah. Hello.
Yes.
Okay. So return on equity. You remember this? I did leverage return. Leverage return.
Yes.
That one only. See, initially 1,000, operating expense 800, interest is not there. So we are having 200 now. Net
So your
income
screen
200.
share is on.
Acha, screen share is not there. Okay, okay. Huh. Okay. Huh. Okay. So here 200 is the net income. So your return on equity is 200 to 20 percentage. Okay. Return on equity is 20 percentage. So this is return on equity means net profit by average equity. So this is 200 divided by 2000, 20%. Then now suppose if you borrow money. So here what happens? So they are saying instead of having this 1,000 rupees on your own, 50-50. Yeah, so here written, okay, 50-50. So 500 equity and 500 bond. So in that case, what would have happened? You have to pay interest. That interest is, they're saying 10%. So 10% interest. So now, here operating expense 800. Now 10% of this 500 comes to 50. So you have to pay 50. So net income is 150. So 150, and then equity is 500. So your profit is 150 divided by return on equity will be 150 divided by 500. So that comes to 30%. That is 30%. 30%. Okay. Then impact of your decrease in revenue. So when it is leveraged, leverage is a double-edged sword. Okay. So in case if revenue comes down, okay. So now you see it is 850 instead of 1,000. Earlier it was 1,000. Your operating expense is 800. So this operating expense is considered fixed expenses 800, and your net income is 850 minus 850 profit. So 50 profit. So 50 by 1,000 return on equity. That comes to 5%. Okay. Then over here, see, you have to pay 800 plus you have to pay 50 as well. So your income becomes 0. So your return on equity is 0. So leverage, moral of the story, leverage is a double-edged sword. It can, if the sales are going up, it will give you a lot of benefits. If not, losses will also be double then. Okay. Then under shareholder theory, under shareholders theory, the primary, okay, now what is shareholders theory? Under this theory, these are some theory, simple theory. Corporate governance is primarily concerned with the conflict of interest between the firm's managers and its owners. Now, what is the conflict of interest here? Shareholder, as a shareholder, my intention is to maximize the profit. So shareholders' intention is shareholders' point of view, maximize the profit. And shareholders' point of view, maximize the profit. Whereas managers' point of view, what do they want? They have to balance between profits and keeping employees happy also. That means they have to pay bonus. And if they pay bonus, the profit will come down. Keeping employees happy. So there is a conflict. They want only maximum profit. So they will say, like, make people to work for, long hours. Because as a shareholder, that's how they will speak. But managers' point of view, they have to make sure that employees are also happy. Because then only the productivity will go up in the long run. Okay. Then, so that is the conflict. So that is called shareholders theory. Okay. Then all these are fine. Board of directors perspective include inside directors. Inside directors means who are working there, senior executives, founders. Okay. And independent directors means who are not an employee of the company. So why are they appointed? They are appointed so that they can protect minority shareholders' interests. Okay, so independent directors are the representative of the minority shareholders. Okay. So more the board of independent board of directors, it is better because the insiders can do any sort of manipulations, right? So in order to have a check on that one, independent directors are appointed. Then one tier board structure and two tier structure. So we have one tier. One tier means both inside and independent directors. They all sit on the same, on a single board, and then they will take decisions, whatever decisions they want to make. That is called one tier board structure. Here, two tier board structure means inside directors will sit and then they will come up with one. So in Europe, it is done. Okay, inside you know inside directors will sit first. They will come up with some conclusions and then they will send that report to the independent board of directors, and independent board of directors will come together and then they will sit and then they will decide whether it is okay or not. So they both are working separately. That's why it is called two tier structure. Okay, so in which the independent directors serve on a supervisory board that oversees the management board comprising inside directors. Is it fine? Okay.
Yes, sir.
Yeah. Then typically board members are elected for a specified term. So normally in a staggered board, only a fraction of the board is elected each year. Yeah, normally 3 years or so they are appointed, as far as I can recollect. Okay. Then this is all fine. Normal theory, supplier, customers. Negative externalities. ESG is an important point. Okay, wherever you see ESG, better you just read it. Even though they have not elaborated anything, but it is okay to read about ESG. Okay, I cannot see any important point here. But wherever you see ESG, better you read. Okay, it is there in multiple subjects. Now, negative externalities arise when a company or its investors do not bear the full cost of its actions. Okay, say for example, imagine there is a village. So now there is a factory over here. Now this factory people are releasing some harmful chemicals, in the river. This is the river. Okay, this is the river. Now this is the river. Okay, this is the river. So they are releasing water here. Now these are all villagers who are using that water. Now these villages have got nothing to do with this business, but still they are getting impacted, right? Okay, so they have got nothing to do with that business factory, but still their livelihood is getting impacted. Or you just see around what is happening to climate change now. So we are seeing now rainfall even in November now. So that means why is this happening? Because of all the tree cutting development and all those things, for which some people may not be a part of it also. Some people may not be even using all the advanced developments that government is trying to do. Okay, so in that case, then that will be considered as negative externalities for them. Because like let's say pollution. Now imagine pollution is going high and high. Now pollution is going up and up for whatever reasons, but there might be somebody who is not driving, who is not uh, doing any activities that can lead to pollution, but still he has to breathe polluted air only, no? That person. So that is called negative externalities. Okay. Then environmental factors, physical risk of adverse effects. Okay. Yeah, with respect to climate change, companies may face physical risk of adverse effects on assets and or operations if severe weather increases in frequency. Correct. Physical risk of adverse effects. That means, during flood and all, what happens? Lots of machines or car, they get spoiled, right? Okay, because of water. Okay, that is physical risk. Then transition risk, as government regulations or consumer choices require switching from high carbon to low carbon. Shift your plant from one place to another place. Okay, that is transition risk. Then stranded assets. Stranded means which cannot be shifted also, are those that become unviable due to such changes. Over a period of time, there is no point changing it. If you shift, it will be of no use. Those are all stranded assets, which will also harm the environment. You may even see there are, at times you will see very old car on the road. Who bought, we have no idea, and then it is just lying there on the road. Similarly, imagine big machines, all those things will be there, okay, which are just standard only. So those are all standard assets. Okay, even if you travel by train, on the way you will find, sometimes you will find there are certain stations where you will find kind of ghost buildings outside. Have you seen? If you travel by train now, you will find
Yes.
people. So those are all something. Once upon a time there used to be mill companies. Okay, so once upon a time there used to be mill companies. Now that must be in some sort of legal issues or what, I don't know. But those become standard assets, like, whosever's that asset is. Okay, that is of no use, that kind of thing. Okay. Standard means which you cannot shift, it becomes unviable to shift also, so you are not able to use it as well. Or imagine in oil companies, you must have again seen some sort of pics where they will show in inside the sea there will be some machines put, and they will be extracting oil. So that also becomes standard assets, because after that you cannot keep on moving the assets here and there. So whatever they machines they use, and then they extract oil, then they leave it there only. So all these are harmful for the marine life, and all these are what standard assets, harmful for the environment. Then corporate governance, yeah. Now principal agent conflict. Agent is hired to act in the interest of the principal. uh, Acha, 1 second, I have to explain something about that stakeholder. I think I missed that stakeholders theory. Uh-huh. So I was explaining about shareholder stakeholders theory. The focus of government corporate governance under stakeholders theory is broader. So what is the difference between stakeholders theory and shareholders theory? Shareholders theory, I explained it. Now stakeholder means what? What is the difference between shareholder and stakeholder? See, stakeholder will consider everybody who is associated with the company. That means stakeholder will include stakeholder will include uh, supplier. He is also a stakeholder. Okay. Stakeholder will include uh, employees. Okay. Then stakeholders will include a bank which has given loan. Okay. So stakeholder will include shareholders. So everybody will have their own expectations. Correct. That is called stakeholders theory. So it considers several groups that have an interest in the activities and performance. So everybody's expectations will be taken care here. Whereas shareholders theory means what shareholders are thinking. Okay, that is shareholders theory. That is the difference between shareholders theory and stakeholders theory. Okay.
Okay.
Now, principal agent relationship is, again, this is shareholders theory only. Principal agent relationship means principal is principal means shareholders here, and then agent means managers. So principal agent relationship. In such a relationship, principal agent conflict has the potential to rise because an agent is hired. Agent means manager is hired to act in the interest of the principal. That means to make more profits for the shareholders. But an agent's interest might not coincide exactly with those of the principal. Why? Because agent wants both to be happy, shareholders as well as the employees. And when will the employees be happy? When you share some profits to them also in the form of bonus, hike in salary, and all those things. So that's why when you increase the salary highly, then again employees, shareholders may not like them. Okay. Agency cost are the cost of your agency costs are the cost of your principal agent conflict. Agency costs can be direct, such as hiring employees to monitor the agent. So this is agency cost that includes monitoring cost. Okay, monitoring cost, because if you are having agency means managers, so they are hired to monitor. So monitoring cost will be there. Then uh, then auditing cost, monitoring auditing cost. Then residual cost. Residual means you have to allow your managers to take risk, innovate and innovate new products, innovate and then make new products and take risk. And if that product fails also, the shareholders are only getting impacted, right? But you have to allow your managers to do this. Otherwise, the company cannot progress. Okay, that is called residual cost. That means opportunity cost of lost, and then yeah, opportunity cost of lost business. Yeah. Okay. So like this various agency cost you have to incur. Uh, then information asymmetry. Information asymmetry always will be there. Now you tell me, if I'm holding Reliance company shares, so I am one shareholder. I'm holding Reliance company shares. And there is a Reliance company's board of director who is just an employee. Who is the owner? I am the owner. Now, who has better information about Reliance? One shareholder or board of directors? Board of directors will have better information, but owner is sitting here. So that's why, because board of directors know about the company better than the owner himself, that is called information asymmetry. It is not symmetrical; it is asymmetry. Okay, because of which he has to pay more money. Retention cost. There can be retention cost, so that you make sure that employees don't leave the company. They will get bonus. Okay. Then yeah, then dual class structure. So equity shareholders can have dual class structure. Dual class means what? Like in US, they say like this: class A shares, class A share, and class B shares. So class A share means what? Class A share means class A share means what? Class A share means they will get voting rights, let's say. And here no voting rights. In India, we call this as DVR, differential voting rights. That means normal company, let's say Jain Irrigation. Now this is one company. Now there will be another one, Jain Irrigation DVR. So if this is trading at 100, this will be trading at 70. So this is differential voting rights. So these people will not get voting rights for them, no voting rights. So this is good for people like us who are not interested in the voting rights. We are interested only in to see the prices going up, right? We are not worried about votings. We are not participating in the management. Okay. Proxy means you are appointing somebody else to vote on your behalf. That is called proxy. When you cannot vote directly because you are traveling or whatever reasons, so you tend to appoint somebody else. Or otherwise also you can appoint somebody else because you don't want to think about whom to vote. You will have somebody else who will think and decide whom to vote. That is proxy. Activist shareholders, they pressurize companies in which they hold a significant number of shares for changes they believe will increase shareholders value. So these are all activists. Like we have activists in the environment, in the society. If you cut trees, they will come and try to stop it. So they are worried for the environment. Similarly, these are activist shareholders for the companies. Then tender offer means when you want to buy. Tender offer is acquisitions. When you want to buy shares of another company and you want to acquire that company to gain control, that is called tender offer. Okay, tender offer means you think like it is an offer to acquire another company, okay, to gain control. So you are able to understand this one, this line. Proxy contest means they are having their own contest to see what is the thought of the shareholders. Okay. Then hostile takeover means what now? Hostile takeover means when you want to take over a company without the permission of the target company. That is called as hostile takeover. See, there is something called friendly takeover and there is something called hostile takeover. Friendly takeover and hostile takeover. Okay, so friendly takeover means both target and acquiring companies are okay with it. Acquiring company and target company. Okay. So they both are fine with it. Okay. They both are happy. Hostile takeover means hostile takeover means what? Hostile takeover means acquiring a target company is not happy with the acquiring company. They are forcefully taking over acquiring company. So when they're forcefully taking over acquiring company, then it becomes hostile takeover. Okay. So at times it is possible because this company founder might be a minority shareholder. Okay. So in that case, it is possible that some other company may acquire the company. Like you see, NDTV was acquired by Adani Group, right? Such kind of news came up. So that was an hostile takeover because NDTV had he never wanted to sell NDTV to Adani company. Okay, but then it was taken over. So that is the example of hostile takeover. Okay. Then poison pill. Poison pill means these are some other ways to escape when there is takeover. So poison pill means basically, you know, low price additional shares will be issued to the current shareholders. This way, what will happen? Share price will come down highly. If share price is coming down highly, the value of the company will come down. When the value of the companies are coming down, it will make less attractive. So that acquiring company may not then be interested in it. So it is like, companies taking poisons so that it becomes less attractive and the acquiring company will not try to take over. Okay. So they are kind of killing themselves only so that the acquiring company doesn't come. Okay. Then bond endanger means what? Bond endanger as in the prospectus. And then covenant means okay. Okay. Then covenant, you remember, these are all additional conditions put down by the lenders when they lend money. Okay. Covenant. Then yeah, this is all fine. Which are working capital. Okay, just go through this. You remember we have done all this in
Yes.
accounting itself. You may just go through this now.
Okay.
Okay. Okay. Reading fine. Reading 23, no? Okay. I think this also what we will do is we'll just stop now here. I think this is a new reading only, right? We'll stop now here. Evening, if I get time, I'll just let you know, or else we'll do tomorrow. In 1 or 2 sessions, it will be done. Okay.
Okay, sir.
Okay. We'll stop now here.
Thank you, sir.
Okay.